Millionaires who have achieved success on their own have been growing increasingly common during the past few years. This demonstrates that everyone may achieve financial success and enjoy life to its fullest. Think about what you could have done if you had extra money at this moment. You would be able to visit more countries or spend more time with your loved ones. I'll demonstrate in this video the 3 key rules and principles that financial experts suggest you do. Welcome to the Wealth Builder Den, your way to financial freedom. We'll help you make good investments and informed financial decisions to build your wealth. Subscribe to the channel. We'll share investment tips and tricks on how to save money and becoming wealthy. Don't forget to click the notification bell to be updated. This will help you avoid wasting any more money. Now, let's get straight into the videos. The lifestyles of thousands of wealthy individuals and financial experts have been the subject of years of studies by a various number of authors. And one common thing they have discovered is that these people all have similar traits. This suggests that by replicating the same actions, everybody can achieve the same outcomes as they did. Stay tuned as we discuss the 3 rules and principles that wealthy individuals and financial experts adhere to. Number 1. The Pareto Principle. This is also known as the 80-20 rule, and it was initially articulated in 1895, and its effectiveness has been consistently proven. According to the rule, 20% of efforts result in 80% of the results. This means that the objective is to identify the specific things you do in your life that lead to the highest results and focus only on those aspects. I'll briefly discuss some of the situations in which this principle can be used. The goal is to make you figure out the actions that will deliver the most return for your investment, time, and effort. This means that focusing on low-income tasks for one whole day would have a lower impact than focusing on high-income tasks for just an hour, for example. When 20% of your customers account for 80% of your revenue, that is a practical example of this. Only 20% of the total revenues would result from concentrating your efforts on selling to the other 80% of the population. However, if you concentrate your efforts on selling to 20% of customers, you would generate 80% of the sales and would be far from efficient with your time. Additionally, 20% of your products, the supply of your goods and services, contribute to 80% of your overall revenues. Therefore, your objective is to concentrate your advertising activities on this crucial 20%. This can mean investing more money in marketing the goods that consumers wish to purchase or raising the standard of the goods. Your staffs are a further illustration of how to put this concept into practice. Let's be honest, everyone is aware of the workers who give it their all every day and those who are only there for the money. It is your responsibility to make sure that you hire and train productive personnel who will increase sales for your company. Last but not least, this principle also applies to the things you do on a daily basis. Unfortunately, a lot of people spend their time on useless pursuits because they believe they are worthwhile. Sure, it could seem like a great idea to respond to comments made by customers on your company's social media page, but you should assign this task to others so that you can concentrate on other crucial tasks. Always think about how significantly a task will help you succeed before you do it. If you've come to a realization that it won't make much of a difference, then you might want to move on to prioritize the other things that you think have much more significant impact instead. The second principle is to keep things simple. This principle is what wealthy individuals and financial experts stick to. This emphasizes keeping all aspects of their financial situation straightforward, uncomplicated, and something they can understand. They are aware that complicated subjects are challenging to follow. Imagine being in a room with 2 scientists speaking about quantum mechanics in technical terminology to each other. You can find it challenging to understand what they are saying if you aren't familiar with their field of study. But if they speak in layman's terms and utilize examples from day-to-day life, you might be able to pick up what they're saying. Yes, quantum mechanics has nothing to do with money, But the main point here is you must realize this principle of keeping things simple must be followed if you are to effectively manage your finances. What is the best way to put this principle into practice? The first step in understanding your finances is to keep track of your income and expenditures. In order to understand where your money is going each month, you must keep track of your costs. You can accomplish that by simply writing down everything you spend money on for the upcoming month, or if you pay all of your payments with the same credit card, by examining your account statement. Additionally, categorizing your spending will make it simpler for you to collect and use more precise financial data. In order to develop a successful strategy for accomplishing your financial goals, you must also identify what they are. Your target may involve trying to save money for a trip or retiring at an earlier age. No matter what your objectives are, keep them uncomplicated if you want to succeed. Automating your funds is the next step following this. In other words, you need to figure out how to make your spending, savings, and investment work with little to no effort on your part. Stay tuned. I'll demonstrate the specific procedures to accomplish this. Keep in mind that the first step in managing your finances is to comprehend them by calculating how much money you earn and spend annually. To organize your finances, you might also apply the 50-30-20 rule. In other words, you must allocate 50% of your money to meet your most essential needs. Spend 30% of what you make on wants, with the remaining 20% going toward debt, repayment, investments, and savings. Keep in mind that this rule is merely a suggestion, and you are free to modify it as necessary. Having your bills paid automatically is the next one to be followed. It can be challenging to keep up with organizing all of the bills you have to pay on a monthly basis. Because of your busy schedule, some bills may occasionally go neglected. Fortunately, automating your bills will help you avoid making this error. Compile the list of all of your monthly expenses. Start with those that are fixed, including your rent, transportation, insurance, loans, subscriptions, and others. A recurrent payment system made possible by technological improvements enables you to set up an arrangement initially and have all of your payments paid automatically afterward. With some payments, like your monthly rent, this might not be possible. However, you can discuss your alternatives with your landlord to reach any agreements. What's even better is that a lot of banks let you do this from the convenience of your home, so you never have to worry about paying your payments again. After learning how to make automatic bill payments, let's discuss how to make savings payments in the same way. Given that most people aren't good at saving money, automation makes it possible to guarantee that you're going to still have enough money for saving after receiving your salary. Making a savings account alongside a checking account is the first step you must do. You can visit your bank and arrange for a specific proportion to be transferred from one account to another every month. I assure you that you'll figure out how to get by on a smaller budget. Finally, let's discuss automatic investing so you can be more financially ready for retirement. You can make automatic contributions to any retirement plan offered by your company, such as a 401k or an individual retirement account. You can contact your HR division to obtain more details regarding your employer-sponsored account. Therefore, organizing your finances will make managing your money simple, lessen stress, and enable you to avoid incurring problematic overdue charges, which you are well aware are entirely unnecessary expenditures. The third principle is the 10% rule. The 10% rule is the third principle that all wealthy individuals and financial experts comply with. There is no set amount that you have to set aside for retirement. However, this guideline recommends that you invest a minimum of 10% of your monthly income toward your retirement. You can use these projections to help you save enough money for retirement thanks to the work of some financial experts. You need to have at least $1 million saved in your retirement account, according to some financial experts. This is presuming you have paid off any other debts, including mortgages, educational loans, and car loans. If you have $1 million saved for retirement, you could comfortably live on $40,000 each year for 25 years. I will now go over how simple it is to adhere to the 10% rule and save $1 million for retirement. And I'll make the assumption that you intend to retire at 65 and show you how much more money you could have if you started investing 10% of your monthly income at ages 25 and 45. In the end, I'll discuss some of the investments you might make to make sure your dreams of retiring are achieved. It's crucial for you to understand that the normal 401k portfolio delivers an average yearly return of between 5 and 8% depending on the state of the market. If you start investing at age 25 and make monthly investments of 10% of your $100,000 annual salary, you will have more than $1 million when you retire. However, if you begin investing at age 45 and earn $100,000 per year, you will have $500,000 at retirement, which is less than half of what you could have earned if you began investing at age 25. So, to have more than $1 million in retirement assets after investing 10%, you would need to make at least $210,000 yearly at age 45. You'll see from these instances that it's best to start investing as soon as possible. The person who began investing the earliest had a higher total return since they gave their funds more time to grow exponentially. In other words, the sooner you start making investments, the more interest your money will earn. Start making investments and transferring funds to retirement accounts as soon as this video is over. I would suggest creating 401k and IRA accounts because they provide tax benefits. Both provide some tax benefits, such as the ability to invest pre-tax income in conventional 401k and IRA accounts. There is also something known as a Roth IRA, which enables you to invest money that has already paid taxes and will ultimately be tax-free in retirement. Stocks, bonds, real estate, mutual and index funds are some of the greatest investments to make if you're wondering how to guarantee you'll have money saved up for retirement. This would allow you to earn passive income. In conclusion, by adhering to the 3 financial principles presented in this video, you can get the best out of your finances. All you have to do is to remain disciplined, stay committed, develop and follow a plan, and fully stick to these principles. Now I hope you guys learned some useful information from this video. We appreciate you for staying till the end. Let us know what you think in the comments section below. Kindly click the like, subscribe, and notification bell icons if you think this video will help you in your future financial decisions. Visit our channel for more financial knowledge, building your wealth, and investment tips and tricks videos that you don't want to miss out. Have a great day and see you in our next video.